Question 1. Compliance review shows that a loan officer at a Birmingham-based bank, while reviewing financial statements for a corporate client, discovers significant, undisclosed negative earnings projections that are expected to be released to the public next week. The loan officer, who has a personal investment account, is considering purchasing shares of the client's stock before the public announcement, believing the current stock price is inflated and will drop significantly once the news is out. What is the most appropriate course of action for the loan officer? Option A. Proceed with purchasing shares of the client's stock, as the information is not yet public and the loan officer's individual trade is unlikely to be detected. Option B. Immediately report the possession of the material non-public information to the bank's compliance officer or legal department. Option C. Discuss the negative earnings projections with a close family member who also invests in the stock market, advising them to sell their holdings. Option D. Wait until the earnings projections are publicly announced and then purchase shares of the client's stock at the anticipated lower price. Correct answer is B. Immediately report the possession of the material non-public information to the bank's compliance officer or legal department. Explanation. Scenario analysis. This scenario presents a common yet challenging situation in banking, where an employee possesses material non-public information, MNPI, that could significantly impact the market value of a company's securities. The professional challenge lies in balancing the employee's personal financial interests with the stringent regulatory obligations designed to maintain market integrity and prevent unfair advantages. Misjudging the situation could lead to severe legal penalties, reputational damage, and loss of trust. Correct approach analysis. The best professional practice involves immediately reporting the possession of MNPI to the designated compliance officer or legal department. This approach is correct because Alabama banking law, like federal securities laws, strictly prohibits trading on MNPI. By promptly disclosing the information, the employee initiates the bank's internal procedures for handling such situations, which typically involve placing restrictions on the employee's trading activities and ensuring that the information is not misused. This proactive step aligns with the duty of care and loyalty owed to the employer and the broader market. Incorrect approaches analysis. One incorrect approach is to proceed with the stock purchase, believing that the information is not material enough to cause significant price movement, or that the employee's individual trade would not be noticed. This is a critical regulatory failure because the definition of materiality is broad and includes information that a reasonable investor would consider important in making an investment decision. Furthermore, the intent to trade on MNPI, regardless of the perceived impact or likelihood of detection, constitutes a violation. Another incorrect approach is to discuss the information with a trusted friend or family member who is also an investor, even with the intention of advising them not to trade. This constitutes a breach of confidentiality and can lead to illegal tipping. Alabama banking law, mirroring federal regulations, prohibits the communication of MNPI to others who might trade on it, even if the intent is to prevent them from losing money. This action can result in liability for both the tipper and the tippee. A third incorrect approach is to wait until after the information becomes public to make the trade. While this avoids the direct act of trading on MNPI, it still raises ethical concerns and could be scrutinized if the employee's actions suggest an intent to profit from the impending public disclosure. The core prohibition is against trading with an informational advantage that is not available to the general public. Professional reasoning. Professionals facing such situations should adopt a conservative and transparent approach. When in doubt about the materiality of information or the permissibility of a transaction, the default action should be to err on the side of caution and seek guidance from the compliance department. This involves understanding the bank's internal policies on MNPI, recognizing the broad definitions of materiality and tipping, and prioritizing ethical conduct and regulatory adherence over potential personal gain. A robust internal reporting mechanism is crucial for navigating these complex issues effectively. Question 2. Strategic planning requires a community bank in Alabama to consider expanding its physical presence. The bank's executive team is eager to open a new branch in a rapidly growing suburban area. They have had a brief, informal conversation with a representative from the Alabama Banking Department who indicated that such expansions are generally viewed favorably if the bank is in good financial standing. The team is debating the best course of action to take to establish this new branch. Which of the following approaches best aligns with the regulatory framework and key legislation governing banking in Alabama? Option A. Initiate a formal application process with the Alabama Banking Department, submitting a detailed business plan that demonstrates the need for the branch, the bank's financial capacity, and compliance with all relevant statutes and regulations. Option B. Proceed with opening the branch after conducting internal market research and obtaining informal verbal confirmation of general support from a contact at the Alabama Banking Department. Assuming formal approval will be a procedural formality. Option C. Analyze the recent branch openings of other banks in the target area and proceed with establishing a similar branch, assuming that regulatory approval will be granted if the location is strategically sound and competitive. Option D. Open the branch immediately to capture market share, and then submit an application to the Alabama Banking Department, arguing that the branch is already operational and serving the community. The correct answer is A. Initiate a formal application process with the Alabama Banking Department, submitting a detailed business plan that demonstrates the need for the branch, the bank's financial capacity, and compliance with all relevant statutes and regulations. Explanation. This scenario is professionally challenging because it requires balancing the bank's desire for growth and innovation with its fundamental obligation to comply with Alabama banking laws, particularly concerning the establishment of new branches. The Alabama Banking Department's regulations are designed to ensure the safety and soundness of the banking system and protect depositors. A hasty or uninformed decision could lead to regulatory penalties, reputational damage, and ultimately, harm to the bank and its customers. The best approach involves a thorough understanding and application of the Alabama Banking Code and the rules promulgated by the Alabama Banking Department regarding branch establishment. This includes identifying the specific statutory requirements for new branches, such as demonstrating a need for the branch, assessing the bank's financial condition, and obtaining the necessary approvals from the superintendent of banks. This approach prioritizes regulatory compliance and a well-reasoned business case, aligning with the principles of safe and sound banking practices mandated by Alabama law. An approach that bypasses the formal application process and relies solely on internal discussions and informal assurances from a regulator is professionally unacceptable. This fails to adhere to the explicit procedural requirements outlined in the Alabama Banking Code for branch establishment. It also carries the significant risk of misinterpreting regulatory guidance or acting on incomplete information, which could lead to a violation of state law and subsequent enforcement actions by the Alabama Banking Department. Another unacceptable approach is to proceed with the branch opening based on a competitor's actions. While market analysis is important, it does not substitute for the specific legal requirements for branch establishment in Alabama. Each bank's application must be evaluated on its own merits according to the law, not by simply mirroring what others may have done. This approach ignores the regulatory framework and could result in an improperly established branch, subject to closure and penalties. Finally, an approach that prioritizes speed over compliance, assuming that the regulator will approve the branch post facto, is a serious ethical and legal misstep. Alabama banking law requires pre-approval for branch establishment. Operating a branch without this approval is a direct violation of the law and undermines the supervisory authority of the Alabama Banking Department. Professionals should approach such decisions by first consulting the relevant Alabama Banking Code sections and administrative rules. They should then develop a comprehensive business plan that addresses all statutory requirements, including market analysis, financial projections, and operational plans. This plan should be formally submitted to the Alabama Banking Department for review and approval. Engaging in open and transparent communication with the regulator throughout the process, while adhering to established procedures, is crucial for successful and compliant expansion. Question 3. The monitoring system at First National Bank of Alabama flags an unusual pattern of access to a customer's account, including multiple failed login attempts followed by a successful login from an IP address not previously associated with the customer. This activity occurred outside of the customer's typical banking hours. What is the most appropriate and legally compliant course of action for First National Bank of Alabama to take? Option A. Notify the customer that their account may have been accessed by an unauthorized party, but provide no further details or assistance. Option B. Ignore the alert, assuming it is a false positive generated by the monitoring system, and continue with normal operations. Option C. Immediately contact the local law enforcement agency to report a suspected cybercrime without conducting any internal investigation or notifying the customer. Option D. Immediately initiate a formal internal investigation. Secure the affected account to prevent further unauthorized access. Notify the customer of the potential compromise and provide guidance on protective measures, and report the incident to the Alabama State Banking Department as required by law. The correct answer is D. Immediately initiate a formal internal investigation. Secure the affected account to prevent further unauthorized access. Notify the customer of the potential compromise and provide guidance on protective measures, and report the incident to the Alabama State Banking Department as required by law. Explanation: the monitoring system demonstrates a potential breach of customer privacy and data security protocols, which is a significant professional challenge for any financial institution operating under Alabama banking law. The core of this challenge lies in balancing the need for internal oversight and fraud detection with the strict requirements for safeguarding customer information, as mandated by Alabama statutes and federal regulations applicable to state-chartered banks. A hasty or incomplete response could lead to regulatory penalties, reputational damage, and loss of customer trust. The best approach involves a thorough, documented investigation that prioritizes data security and regulatory compliance. This means immediately isolating the suspicious activity to prevent further unauthorized access, while simultaneously initiating a formal internal investigation. This investigation must be conducted by designated personnel, adhering to established protocols for handling potential data breaches. Crucially, this approach requires prompt notification to the customer whose information may have been compromised, providing them with clear guidance on protective measures, and also involves timely reporting to the Alabama State Banking Department as required by law. This comprehensive response ensures that all regulatory obligations are met, customer rights are protected, and the bank's internal controls are assessed and strengthened. An incorrect approach would be to dismiss the alert without a proper investigation, assuming it is a system error. This fails to acknowledge the potential for a genuine security incident and violates the duty of care owed to customers and the regulatory obligation to maintain secure systems. Such inaction could result in significant harm to the customer and expose the bank to severe penalties for negligence and noncompliance with data protection laws. Another unacceptable approach is to immediately contact law enforcement without first conducting an internal assessment and notifying the customer. While law enforcement involvement may be necessary in certain circumstances, bypassing internal investigation and direct customer notification can violate privacy laws and procedural requirements. The bank has a primary responsibility to investigate and inform the affected individual before escalating to external agencies, unless immediate criminal activity is evident and poses an imminent threat. Finally, an incorrect response would be to inform the customer of a potential breach, but fail to provide specific guidance or offer assistance in mitigating potential harm. This approach is insufficient, as it fulfills the notification requirement superficially, but neglects the ethical and regulatory imperative to actively help the customer protect themselves from identity theft or financial fraud resulting from the breach. Professionals in this situation should employ a decision-making framework that begins with acknowledging the alert as a serious potential issue. The next step is to activate predefined incident response protocols. This involves containment, investigation, and assessment of the scope and impact. Throughout this process, adherence to Alabama banking law and relevant federal regulations regarding data privacy and breach notification is paramount. Documentation of every step taken is essential for demonstrating compliance and for future review and improvement of security measures. Question 4. The monitoring system demonstrates that a large Alabama chartered bank has identified emerging risks related to cross-border financial activities. While the Alabama Banking Department has not issued specific regulations addressing these particular risks, the bank's senior management is aware that international bodies such as the Basel Committee on Banking Supervision and the Financial Stability Board have published guidance and recommendations on managing such risks. What is the most prudent course of action for the bank to take in response to this situation? Option A. Disregard the recommendations from international bodies, as they are not legally binding within Alabama and could impose unnecessary compliance burdens. Option B. Wait for explicit directives or regulations from the Alabama Banking Department before making any changes to the bank's risk management practices related to these emerging risks. Option C. Proactively integrate the principles and standards set forth by international regulatory bodies into the bank's internal policies and risk management frameworks, even in the absence of direct Alabama mandates. Option D. Selectively adopt certain international recommendations that appear most straightforward to implement, without a comprehensive review of their impact on the bank's overall risk profile. Correct answer is C. Proactively integrate the principles and standards set forth by international regulatory bodies into the bank's internal policies and risk management frameworks, even in the absence of direct Alabama mandates. Explanation: this scenario is professionally challenging because it requires a bank operating in Alabama to navigate the complex interplay between domestic banking regulations and the recommendations of international bodies. The challenge lies in understanding when and how to incorporate principles from organizations like the Basel Committee on Banking Supervision, BCBS, and the Financial Stability Board, FSB, into their risk management frameworks, especially when these recommendations are not directly codified into Alabama state law. The bank must balance compliance with state-specific mandates, with the strategic advantage of adopting globally recognized best practices to enhance its resilience and reputation. The best approach involves proactively integrating the principles and standards set forth by international regulatory bodies into the bank's internal policies and risk management frameworks. This means understanding that while the Alabama Banking Department enforces state laws, the BCBS and FSB provide foundational guidance for sound banking practices globally. By adopting these international standards, the bank demonstrates a commitment to robust risk management that aligns with global expectations, potentially leading to better capital adequacy, liquidity management, and overall financial stability. This proactive stance not only helps in anticipating future regulatory changes, but also positions the bank favorably in the eyes of both domestic and international stakeholders, including potential investors and rating agencies. This approach is correct because it acknowledges the evolving nature of financial regulation and the increasing interconnectedness of the global financial system, where international standards often serve as a precursor or benchmark for domestic legislation. An approach that solely relies on waiting for explicit mandates from the Alabama Banking Department before considering international recommendations is professionally deficient. This passive stance risks falling behind industry best practices and could leave the bank vulnerable to risks that are already being addressed by more forward-thinking institutions globally. It fails to recognize the advisory and standard-setting role of bodies like the BCBS and FSB, which aim to promote financial stability through harmonized regulations. Another professionally unacceptable approach is to dismiss the recommendations of international bodies entirely, arguing that they are not legally binding in Alabama. This overlooks the fact that these bodies' work heavily influences the development of national and state banking regulations. Ignoring them means potentially missing critical insights into emerging risks and effective mitigation strategies, thereby increasing the bank's exposure to systemic risks and reputational damage. Finally, an approach that selectively adopts international recommendations without a comprehensive understanding of their implications or without a systematic integration into the bank's overall risk management strategy is also flawed. This piecemeal adoption can lead to inconsistencies and gaps in the bank's risk governance, potentially creating new vulnerabilities rather than strengthening the bank's resilience. Professionals should adopt a decision-making framework that involves continuous monitoring of both domestic regulatory developments and international best practices. This includes actively engaging with industry associations, attending relevant conferences, and conducting thorough internal assessments to understand how international standards can enhance existing risk management frameworks. The goal is to foster a culture of proactive compliance and continuous improvement, ensuring the bank operates not only within the letter of the law, but also in the spirit of sound and resilient financial intermediation. Question 5. The monitoring system demonstrates a discrepancy between a long-standing customer onboarding process at an Alabama-based credit union and current regulatory expectations. The process, established in the early 1990s, involves a less stringent verification of identification documents compared to contemporary standards. The credit union's compliance officer is tasked with determining the appropriate course of action. Which of the following represents the most prudent and legally sound approach under Alabama banking law? Option A. Conduct a comprehensive review of the credit union's current onboarding procedures against the most recent provisions of the Code of Alabama and regulations issued by the Alabama State Banking Department, specifically focusing on identification verification requirements, and implement necessary updates to align with current legal mandates. Regardless of the historical practice, Option B. Continue with the existing onboarding process, citing its historical precedent and the absence of any explicit prohibition in the credit union's founding documents from the early 1990s, assuming that if it were problematic, it would have been addressed by regulators by now. Option C. Seek to amend the credit union's founding documents to retroactively legitimize the current onboarding process, rather than altering the process itself, arguing that the historical practice reflects the credit union's established operational norms. Option D. Rely on interpretations of banking practices from the early 1990s, as documented in internal credit union memos from that era, to justify the current onboarding procedures, believing that these historical guidelines reflect the spirit of banking law at the time and are still applicable. The correct answer is A. Conduct a comprehensive review of the credit union's current onboarding procedures against the most recent provisions of the Code of Alabama and regulations issued by the Alabama State Banking Department, specifically focusing on identification verification requirements, and implement necessary updates to align with current legal mandates, regardless of the historical practice. Explanation. The monitoring system demonstrates a potential compliance issue that requires careful judgment due to the evolving nature of banking regulations in Alabama. The challenge lies in distinguishing between historical practices that may no longer align with current Alabama banking law and legitimate, albeit older, operational procedures. A bank must navigate this by understanding the historical context of its operations while strictly adhering to the present legal framework established by the Alabama legislature and enforced by the Alabama State Banking Department. The correct approach involves a thorough review of the bank's current policies and procedures against the backdrop of Alabama banking statutes and regulations, particularly those that have undergone significant revision or were introduced to address specific historical challenges in the state's financial sector. This requires understanding the intent behind landmark legislation, such as early consumer protection laws or statutes designed to stabilize the banking system after periods of economic distress in Alabama. By identifying specific provisions in the Code of Alabama that govern the practices in question and comparing them to the bank's operational reality, the bank can accurately assess compliance. This method ensures that the bank is not only aware of its historical operational context, but is actively ensuring its present actions are legally sound under current Alabama law. An incorrect approach would be to rely solely on the fact that a practice has been in place for a long time, assuming its historical existence validates its current legality. This fails to acknowledge that banking laws are dynamic and are updated to reflect economic changes, technological advancements, and evolving societal expectations within Alabama. Another incorrect approach is to interpret historical banking documents or internal memos as definitive legal guidance for current operations, without cross-referencing them with the most recent Alabama banking statutes and regulations. This can lead to outdated practices being maintained, potentially violating current legal requirements. Finally, assuming that a lack of explicit prohibition in older banking documents means a practice is permissible under current law is also flawed. Modern Alabama banking law often operates on principles of prudence and consumer protection that may implicitly disallow certain historical practices, even if not explicitly forbidden in historical texts. Professionals should employ a decision-making process that prioritizes current statutory and regulatory compliance. This involves a continuous cycle of reviewing internal policies against the latest Alabama banking laws, seeking legal counsel when in doubt, and understanding the historical evolution of banking law in Alabama to better interpret the intent and application of current regulations. Question 6. The assessment process reveals a financial technology company in Alabama proposing to offer a service that pools customer funds and uses them to make short-term loans to small businesses, with the company taking a percentage of the interest earned. Considering the definition and scope of banking law in Alabama, Which of the following best describes the regulatory consideration for this service? Option A. The service is likely outside the scope of Alabama banking law because it is a new financial technology offering and not explicitly listed as a traditional banking activity in the Alabama Banking Code. Option B. The service is permissible as long as the company does not hold a formal banking charter issued by the state of Alabama, as the Alabama Banking Code only applies to chartered institutions. Option C. The service must be evaluated against the statutory definition of banking business in the Alabama Banking Code to determine if it constitutes the receipt of money for deposit or the lending of money or activities deemed by the Alabama State Banking Department to be part of the banking business, regardless of its novel structure. Option D. The service is permissible if the company's internal policies and procedures are robust, even if the activity could be interpreted as engaging in banking business, as regulatory oversight focuses primarily on the risk of failure rather than the nature of the activity itself. The correct answer is C. The service must be evaluated against the statutory definition of banking business in the Alabama Banking Code to determine if it constitutes the receipt of money for deposit or the lending of money or activities deemed by the Alabama State Banking Department to be part of the banking business, regardless of its novel structure. Explanation. The assessment process reveals a common challenge in banking regulation, distinguishing between activities that fall squarely within the definition of banking and those that might be ancillary or related services. This requires a deep understanding of the Alabama Banking Code and its intent to protect depositors and maintain financial stability. The scenario is professionally challenging because it involves interpreting the scope of banking law in a context that is not explicitly defined as traditional deposit taking or lending, necessitating careful judgment to avoid regulatory breaches or unintended consequences. The correct approach involves a thorough examination of the proposed activities against the statutory definition of banking business, as defined in the Alabama Banking Code. This includes considering whether the activities involve the receipt of money for deposit, the lending of money, or other activities that are intrinsically linked to the core functions of a bank. Specifically, if the proposed services, even if novel, are fundamentally about intermediating funds, managing financial risk for others in a manner akin to deposit taking or lending, or are otherwise deemed by the Alabama State Banking Department to be part of the banking business, then they fall under the purview of Alabama banking law. This approach is correct because it prioritizes adherence to the established legal framework designed to regulate financial institutions and protect the public. The Alabama Banking Code aims to provide a comprehensive regulatory structure for entities engaging in banking activities, and a broad interpretation that encompasses functionally similar operations ensures that the regulatory intent is upheld. An incorrect approach would be to assume that any activity not explicitly listed as a prohibited or regulated banking activity in the code is automatically outside its scope. This fails to recognize that banking law often operates on principles and functional definitions, not just exhaustive lists. For instance, if a company offers a service that, while not a traditional deposit, effectively pools customer funds and uses them for investment or lending purposes, it could be construed as engaging in banking business. Another incorrect approach would be to rely solely on the company's self-classification or the absence of explicit regulatory guidance for a specific niche service. Regulatory bodies often have the authority to interpret and apply existing laws to new or evolving business models. Ignoring the potential for regulatory oversight based on the substance of the activity rather than its superficial form is a significant ethical and legal failure. Professionals should employ a decision-making framework that begins with a comprehensive review of the relevant statutory definitions and regulatory pronouncements. When faced with ambiguity or novel business models, they should consult with legal counsel specializing in Alabama banking law, and if necessary, proactively engage with the Alabama State Banking Department for clarification or guidance. This proactive and thorough approach ensures compliance and mitigates risk. Question 7. Process analysis reveals that an Alabama chartered bank has identified a significant increase in its exposure to interest rate risk due to a rapidly changing economic environment. The bank's management is considering implementing a series of aggressive hedging strategies to protect its balance sheet. Considering the role of the Federal Reserve System as the central bank for the United States, which of the following approaches best reflects responsible risk management and regulatory compliance for this Alabama bank? Option A. Proactively assess the specific interest rate risk exposures, develop targeted hedging strategies, and engage in open communication with the Federal Reserve to discuss the proposed measures and their potential impact on broader financial stability and economic conditions. Option B. Implement aggressive hedging strategies immediately to fully insulate the bank from interest rate fluctuations, without prior consultation with the Federal Reserve, assuming the primary responsibility is to protect shareholder value. Option C. Focus solely on internal risk mitigation techniques, such as reducing loan origination in interest-sensitive sectors, without considering the broader economic implications or informing the Federal Reserve of the potential impact on credit markets. Option D. Delay any significant hedging actions or communication with the Federal Reserve until the interest rate environment stabilizes, prioritizing internal operational continuity over proactive risk management and regulatory engagement. The correct answer is A. Proactively assess the specific interest rate risk exposures, develop targeted hedging strategies, and engage in open communication with the Federal Reserve to discuss the proposed measures and their potential impact on broader financial stability and economic conditions. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a banking institution in Alabama to navigate the delicate balance between implementing necessary risk mitigation strategies and adhering to the regulatory mandate of supporting economic stability, as overseen by the Federal Reserve System, acting as the central bank for the U.S., including Alabama. The institution must assess the potential impact of its actions on broader financial markets and the economy, a responsibility that extends beyond mere internal risk management. Careful judgment is required to ensure that risk reduction measures do not inadvertently create systemic instability or contradict the broader economic objectives championed by the central bank. Correct approach analysis. The best professional practice involves a proactive and collaborative approach with the Federal Reserve. This entails thoroughly assessing the internal risk exposures of the Alabama bank, identifying specific vulnerabilities that could lead to financial distress, and then engaging in open communication with the Federal Reserve. This communication should detail the identified risks, the proposed mitigation strategies, and an analysis of how these strategies align with or might impact the Federal Reserve's broader monetary policy and financial stability objectives. This approach is correct because it directly addresses the dual mandate of financial institutions, maintaining their own solvency and contributing to the stability of the overall financial system, as implicitly guided by the Federal Reserve's role. It demonstrates a commitment to regulatory compliance and responsible corporate citizenship within the U.S. financial framework. Incorrect approaches analysis. One incorrect approach involves solely focusing on internal risk mitigation without considering the broader economic implications or consulting with the Federal Reserve. This failure stems from a narrow interpretation of risk management, neglecting the systemic responsibilities of financial institutions within the U.S. economy. Such an approach risks implementing measures that, while internally sound, could have unintended negative consequences on credit availability or market liquidity, potentially counteracting the Federal Reserve's policy goals. Another incorrect approach is to implement aggressive risk reduction measures that could significantly curtail lending or investment activities without prior consultation or justification to the Federal Reserve. This could be perceived as an overreaction or a misinterpretation of risk, potentially leading to a contraction in economic activity that the Federal Reserve aims to prevent or manage. It bypasses the collaborative dialogue expected between regulated entities and the central bank. A third incorrect approach is to delay or avoid communication with the Federal Reserve regarding significant risk exposures and proposed mitigation strategies. This lack of transparency can erode trust and prevent the Federal Reserve from offering guidance or support, potentially exacerbating the situation. It also fails to acknowledge the Federal Reserve's oversight role in ensuring the health of the U.S. financial system. Professional reasoning. Professionals should adopt a framework that prioritizes understanding the interconnectedness of their institution's health with the broader economic landscape. This involves continuous risk assessment, staying abreast of Federal Reserve pronouncements and policy objectives, and fostering open lines of communication with regulatory bodies. When significant risk exposures are identified, the decision-making process should include evaluating the potential systemic impact of mitigation strategies and proactively engaging with the Federal Reserve to ensure alignment with national economic goals. Question 8. The audit findings indicate that First National Bank of Alabama may not be adequately identifying and quantifying emerging risks. Which of the following approaches to risk assessment would best address these findings in accordance with Alabama banking law's emphasis on proactive risk management and the safety and soundness of financial institutions? Option A. Implement a comprehensive risk assessment framework that integrates qualitative methods, such as scenario analysis and expert judgment, with quantitative methods to evaluate the likelihood and impact of identified risks. Option B. Outsource the entire risk assessment process to an external risk management firm without establishing internal validation or oversight mechanisms. Option C. Rely primarily on historical loss data and past audit reports to identify and assess potential risks, assuming that future risks will mirror past events. Option D. Focus risk assessment efforts exclusively on compliance-related risks, as these are the most directly regulated by state and federal authorities. The correct answer is A. Implement a comprehensive risk assessment framework that integrates qualitative methods, such as scenario analysis and expert judgment, with quantitative methods to evaluate the likelihood and impact of identified risks. Explanation: scenario analysis. This scenario is professionally challenging because it requires the bank to balance the need for efficient risk management with the imperative to comply with Alabama banking law. The audit findings highlight a potential gap in the bank's ability to proactively identify and quantify emerging risks, which could lead to significant financial losses or reputational damage if not addressed. The challenge lies in selecting a risk assessment methodology that is both robust enough to capture these nuances and practical for implementation within the bank's operational framework, all while adhering to regulatory expectations for sound risk management practices in Alabama. Correct approach analysis. The best professional practice involves implementing a comprehensive risk assessment framework that integrates both qualitative and quantitative methods. This approach begins with a thorough identification of all potential risks, including operational, credit, market, liquidity, compliance, and strategic risks. Following identification, risks are analyzed and evaluated based on their likelihood and potential impact. Qualitative methods, such as expert judgment, scenario analysis, and risk workshops, are crucial for understanding the nature and potential impact of less quantifiable risks or emerging threats. Quantitative methods, where applicable, are used to assign numerical values to risk likelihood and impact, allowing for prioritization and resource allocation. This integrated approach ensures that the bank has a holistic view of its risk profile, enabling proactive mitigation strategies and informed decision-making, which aligns with the Alabama banking law's emphasis on prudent risk management and the safety and soundness of financial institutions. Incorrect approaches analysis. One incorrect approach involves relying solely on historical data and past loss events to assess risk. While historical data is valuable, it fails to account for emerging risks, changes in the economic environment, or new business strategies that may introduce novel threats. This approach is insufficient because it is inherently backward-looking and may not adequately prepare the bank for future challenges, potentially violating the spirit of proactive risk management mandated by Alabama banking law. Another unacceptable approach is to focus exclusively on regulatory compliance risks without considering broader strategic or operational risks. While compliance is critical, a narrow focus can leave the bank vulnerable to other significant threats that could impact its financial stability and reputation. This approach neglects the interconnectedness of various risk types and fails to provide a complete picture of the bank's risk exposure, which is a fundamental requirement for sound risk management under Alabama banking law. A third flawed approach is to delegate risk assessment entirely to external consultants, without establishing robust internal oversight and validation processes. While external expertise can be beneficial, the ultimate responsibility for risk management rests with the bank's management and board of directors. Without internal engagement and understanding, the bank may not effectively integrate the findings into its operations or challenge assumptions, leading to a superficial risk assessment that does not meet regulatory expectations for an effective internal control system. Professional reasoning. Professionals should adopt a structured, multifaceted approach to risk assessment. This involves establishing clear risk appetite statements, defining risk categories, and employing a combination of qualitative and quantitative tools. Regular review and updating of the risk assessment process are essential to adapt to changing internal and external environments. Professionals should prioritize understanding the underlying drivers of risk, not just the symptoms, and ensure that risk mitigation strategies are practical, effective, and aligned with the bank's overall business objectives and regulatory obligations in Alabama. Question 9. Cost-benefit analysis shows that implementing a new digital lending platform could significantly increase revenue for a state-chartered bank operating in Alabama. The bank's compliance team is unsure whether the primary regulatory oversight for this new platform's customer onboarding and loan origination processes rests with the Alabama State Banking Department or a federal agency. What is the most prudent course of action for the bank to ensure compliance with Alabama banking law? Option A. Only engage with the Alabama State Banking Department if a specific compliance issue or customer complaint arises related to the new platform. Option B. Proactively consult with the Alabama State Banking Department to clarify their regulatory jurisdiction and any specific requirements for digital lending platforms operating within the state. Option C. Rely solely on the guidance provided by the Office of the Comptroller of the Currency, OCC, for digital lending platforms, as it is a federal regulator with broad authority. Option D. Assume that federal regulations for digital lending platforms are comprehensive and sufficient, and proceed with implementation without further state-level consultation. The correct answer is B. Proactively consult with the Alabama State Banking Department to clarify their regulatory jurisdiction and any specific requirements for digital lending platforms operating within the state. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a bank to navigate the complex and often overlapping responsibilities of state and federal regulatory authorities in Alabama. Misinterpreting or ignoring the jurisdiction of these bodies can lead to significant compliance failures, penalties, and reputational damage. The bank must accurately identify which authority has oversight for specific activities to ensure proper reporting, licensing, and adherence to regulations. Correct approach analysis. The best professional practice involves proactively identifying and engaging with the Alabama State Banking Department for matters clearly within its purview, such as state-chartered bank operations, branch licensing, and consumer protection regulations specific to Alabama. This approach is correct because the Alabama State Banking Department is the primary state-level regulator for state-chartered banks and financial institutions operating within Alabama. Its authority is established by Alabama state law, and adherence to its directives is mandatory for compliance with state banking regulations. Engaging with the State Department ensures that the bank meets all state-specific requirements, which may be more stringent or tailored to the local economic environment than federal regulations alone. Incorrect approaches analysis. One incorrect approach is to solely rely on federal regulatory guidance from agencies like the OCC or the Federal Reserve, assuming it supersedes all state-level oversight. This is incorrect because Alabama state law grants specific powers and responsibilities to the Alabama State Banking Department, which are independent of federal regulation. Ignoring state-specific requirements can lead to violations of Alabama banking law. Another incorrect approach is to assume that any new product or service automatically falls under the jurisdiction of a federal regulator without first consulting state authorities. This is incorrect because the Alabama State Banking Department has the authority to examine and regulate state-chartered banks and their activities within the state, even if those activities also involve federal oversight. A failure to consult the State Department could result in noncompliance with state licensing or reporting requirements. A further incorrect approach is to only contact regulatory authorities when a specific problem or violation is identified. This reactive approach is professionally unsound because it misses opportunities for proactive compliance and guidance. Regulatory bodies, including the Alabama State Banking Department, often provide interpretive guidance and resources that can help banks prevent issues before they arise. Waiting for a problem to occur can lead to more severe consequences and a more difficult remediation process. Professional reasoning. Professionals should adopt a proactive and comprehensive approach to regulatory compliance. This involves 1. Thoroughly understanding the scope of authority of all relevant state and federal regulators. 2. Maintaining an up-to-date knowledge of Alabama banking law and the regulations promulgated by the Alabama State Banking Department. 3. Establishing clear internal processes for identifying which regulatory body has jurisdiction over specific banking activities. 4. Regularly consulting with legal and compliance experts familiar with Alabama's regulatory landscape. 5. Engaging in open and consistent communication with regulatory authorities, seeking clarification and guidance when necessary. Question 10. The risk matrix shows a potential for significant financial loss due to a complex loan agreement with a new, unproven commercial client in Alabama. The proposed loan has a principal of $500,000, a term of 5 years, a variable interest rate of the prime rate plus 2%, and a balloon payment of $300,000 due at maturity. The client projects a stable annual net operating income of $100,000. If the prime rate increases by an average of 3% over the loan term, what is the total interest paid over the life of the loan, and what percentage of the client's projected total income over the loan term would the total repayment, principal plus interest plus balloon payment represent? Option A. If the prime rate averages 8%, the total interest paid would be approximately $110,000. The total repayment of $910,000 would represent approximately 182% of the client's projected total income of $500,000 over the loan term. Option B. If the prime rate averages 2%, the total interest paid would be approximately $50,000. The total repayment of $850,000 would represent approximately 170% of the client's projected total income of $500,000 over the loan term. Option C. If the prime rate averages 5%, the total interest paid would be approximately $70,000. The total repayment of $870,000 would represent approximately 174% of the client's projected total income of $500,000 over the loan term. Option D. If the prime rate averages 5%, initial prime rate of 2% plus 3% increase, the total interest paid would be approximately $80,000. The total repayment of $880,000 would represent approximately 176% of the client's projected total income of $500,000 over the loan term. The correct answer is D. If the prime rate averages 5%, initial prime rate of 2% plus 3% increase, the total interest paid would be approximately $80,000. The total repayment of $880,000 would represent approximately 176% of the client's projected total income of $500,000 over the loan term. Explanation. The risk matrix shows a potential for significant financial loss due to a complex loan agreement with a new, unproven commercial client. This scenario is professionally challenging because it requires a banker to balance the bank's need for profitability with its fiduciary duty to manage risk prudently, all within the specific legal framework of Alabama banking law. The complexity of the loan terms, particularly the variable interest rate tied to a fluctuating market index, and the inclusion of a substantial balloon payment, necessitates a thorough understanding of contract enforceability and potential legal pitfalls under Alabama law. The best professional practice involves a detailed, quantitative assessment of the client's repayment capacity under various interest rate scenarios and economic conditions, directly impacting the contractual obligations. This approach aligns with the prudent person rule and the fiduciary responsibilities of bank officers under Alabama law, which mandate that financial institutions act with care and diligence in their lending practices. Specifically, Alabama Code Title 5, Chapter 5, A Alabama Banking Code, and related case law emphasize the importance of sound underwriting and risk management. Calculating the potential total cost of the loan to the borrower under adverse conditions, including the impact of the variable rate and the balloon payment, provides a clear picture of the risk exposure. For instance, projecting the total interest paid over the loan term if the index rises by a specified percentage, and then determining if the borrower's projected cash flow can sustain these payments, is a critical step. This involves calculating the future value of the loan under different interest rate assumptions. If the projected total repayment, including principal, interest, and fees, exceeds a reasonable percentage of the borrower's projected income or collateral value, it indicates a high risk of default, which the bank must mitigate or decline. An approach that focuses solely on the initial profitability of the loan without a comprehensive risk assessment fails to meet the standards of Alabama banking law. This would involve overlooking the potential for default if interest rates rise significantly, or if the borrower's business performance deteriorates, leading to a breach of contract or a need for loan restructuring that could be detrimental to the bank. Another unacceptable approach is to rely on a standard contract template without tailoring it to the specific risks of this client and loan structure. Alabama law requires contracts to be clear, unambiguous, and enforceable. A generic template might not adequately address the nuances of a variable rate tied to a specific index or the implications of a large balloon payment, potentially leading to disputes and legal challenges regarding the contract's terms and the bank's obligations. A third incorrect approach is to prioritize closing the deal quickly to meet internal lending targets without adequately verifying the client's financial projections or the collateral's valuation. Alabama banking law expects due diligence. Failing to perform this due diligence means the bank is not acting in a legally sound manner, potentially exposing itself to losses and regulatory scrutiny for imprudent lending. The professional decision-making process should involve a structured risk assessment framework. This begins with understanding the client's business and financial health, followed by a detailed analysis of the proposed loan terms. Crucially, this analysis must include quantitative modeling of potential outcomes, especially under stress scenarios, to ensure the loan is both profitable and sustainable for the borrower, thereby protecting the bank's assets and adhering to Alabama's regulatory requirements for sound banking practices. Question 11. Stakeholder feedback indicates a state-chartered bank operating in Alabama is considering launching a novel digital lending product. The bank's compliance team is debating the primary regulatory authority governing this new offering. Which of the following approaches best ensures compliance with Alabama banking law and its interaction with federal regulations? Option A. Assume that federal regulations from agencies like the OCC or CFPB automatically preempt all state-level oversight for digital lending products offered by a state-chartered bank. Option B. Conduct a thorough review of the Alabama Banking Code and relevant federal banking statutes and regulations, consulting with legal counsel to determine the primary governing framework and ensure adherence to both state and federal requirements. Option C. Proceed with the product launch based solely on the assumption that if the product is permissible under federal law, it will satisfy all requirements under Alabama banking law. Option D. Delay the comprehensive assessment of regulatory requirements until after the product has been fully launched and is in market, addressing any discovered compliance issues reactively. The correct answer is B. Conduct a thorough review of the Alabama Banking Code and relevant federal banking statutes and regulations, consulting with legal counsel to determine the primary governing framework and ensure adherence to both state and federal requirements. Explanation. Scenario analysis. This scenario presents a common challenge for financial institutions operating in Alabama, navigating the dual regulatory landscape of state and federal banking laws. The core difficulty lies in determining which regulatory framework takes precedence when a new product or service is introduced, and ensuring compliance with both without creating conflicts or gaps. Misinterpreting the scope of state versus federal authority can lead to significant legal penalties, reputational damage, and operational inefficiencies. Careful judgment is required to identify the primary governing authority and to understand how state and federal regulations interact. Correct approach analysis. The best professional practice involves proactively identifying the primary regulatory authority for the proposed new product or service under Alabama banking law. This approach necessitates a thorough review of both the Alabama Banking Code and relevant federal banking statutes and regulations, such as those from the OCC, Federal Reserve, or FDIC, depending on the institution's charter and deposit insurance. The institution should then consult with legal counsel specializing in Alabama and federal banking law to confirm the applicable regulatory framework and to ensure the product's design and implementation meet all requirements. This ensures a compliant and robust launch, minimizing risk. Incorrect approach is analysis. Assuming that federal regulation automatically preempts all state regulation for a state-chartered bank operating in Alabama is a significant regulatory failure. While federal law can preempt state law in certain areas, this is not a blanket rule. State-chartered banks are subject to the Alabama Banking Code, and federal preemption must be specifically established. Relying solely on federal guidance without considering Alabama-specific requirements could lead to violations of state law. Another incorrect approach is to assume that if a product is permissible under federal law, it is automatically compliant with Alabama banking law. This overlooks the possibility that Alabama may have additional or more stringent requirements for consumer protection, disclosure, or operational standards that are not mirrored in federal regulations. This can result in non-compliance with state-specific mandates. Finally, delaying the assessment of regulatory requirements until after the product has been launched is a critical operational and ethical failure. This reactive approach significantly increases the risk of discovering noncompliance after the fact, leading to costly remediation, potential enforcement actions by the Alabama State Banking Department, and harm to consumers. Proactive due diligence is essential for responsible product development. Professional reasoning. Professionals should adopt a proactive and comprehensive approach to regulatory compliance. This involves 1. Identifying the institution's charter type, state or national, and deposit insurance status. 2. Thoroughly researching all applicable state laws and regulations, in this case, the Alabama Banking Code and related rules. 3. Researching all applicable federal laws and regulations from relevant agencies, OCC, Federal Reserve, FDIC, CFPB, etc. 4. Analyzing potential areas of conflict or overlap between state and federal regulations. 5. Consulting with legal counsel to interpret complex regulatory issues and confirm compliance strategies. 6. Integrating compliance considerations into the product development lifecycle from the outset. Question 12. Regulatory review indicates that a financial services firm in Alabama intends to establish a new entity that will accept deposits from the public and offer commercial loans. The firm's management believes this entity can operate under a general business license, as it will be providing essential financial services to the local community. What is the most appropriate course of action for the firm to ensure compliance with Alabama banking law? Option A. Assume that the entity's primary focus on commercial lending, rather than consumer deposits, exempts it from the stricter regulations governing traditional banks in Alabama. Option B. Conduct a detailed review of the Alabama Banking Code to determine the specific chartering and licensing requirements for an entity that accepts deposits and makes loans, and consult with legal counsel and the Alabama State Banking Department. Option C. Rely on the operational models of similar financial entities in other states that do not require specific banking charters for deposit-taking and lending activities. Option D. Proceed with establishing the entity under a general business license, assuming that providing financial services to the community is sufficient to legitimize its operations. The correct answer is B. Conduct a detailed review of the Alabama Banking Code to determine the specific chartering and licensing requirements for an entity that accepts deposits and makes loans, and consult with legal counsel and the Alabama State Banking Department. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the desire to expand services with the strict regulatory requirements governing the establishment and operation of different types of banking institutions in Alabama. Misinterpreting or misapplying these regulations can lead to significant legal and financial repercussions, including penalties, loss of charter, and damage to the institution's reputation. The core of the challenge lies in accurately identifying the legal classification of the proposed entity and ensuring compliance with the Alabama Banking Code. Correct approach analysis. The best professional approach involves a thorough review of the Alabama Banking Code to determine if the proposed entity's activities and structure align with the definitions and requirements for a state-chartered bank, trust company, or other specifically regulated financial institution. This would necessitate consulting with legal counsel specializing in Alabama banking law and potentially engaging with the Alabama State Banking Department for clarification or guidance. This approach is correct because it prioritizes regulatory compliance and seeks expert advice to ensure the proposed entity is established and operated within the legal framework, thereby mitigating risk and ensuring lawful operation. Incorrect approach is analysis. One incorrect approach would be to proceed with establishing the entity based on a general understanding of financial services, without a specific analysis of Alabama's banking statutes. This fails to acknowledge the distinct regulatory classifications and requirements for different types of financial institutions in Alabama, potentially leading to operating as an unlicensed or improperly chartered entity. Another incorrect approach would be to assume that, because the entity will offer some financial services, it automatically falls under a less stringent regulatory category, or can operate without specific state chartering. This overlooks the Alabama Banking Code's detailed definitions and the licensing requirements for entities engaging in banking activities, such as accepting deposits or making loans. A further incorrect approach would be to rely solely on industry best practices or the practices of similar entities in other states without verifying their applicability and legality under Alabama law. Alabama has its own specific regulatory framework, and practices permissible elsewhere may not be lawful within the state. Professional reasoning. Professionals facing such a situation should adopt a systematic approach. First, clearly define the intended scope of services and operational structure of the proposed entity. Second, conduct a comprehensive review of the relevant Alabama Banking Code and any associated regulations or guidance from the Alabama State Banking Department. Third, consult with legal counsel experienced in Alabama banking law to interpret the regulations and advise on the appropriate chartering or licensing requirements. Finally, engage proactively with the Alabama State Banking Department to ensure full understanding and compliance before commencing operations. Question 13. Performance analysis shows that a new investment product offering higher potential returns, but also increased volatility, has been launched by your bank. You are meeting with a long-standing client who currently holds a conservative, low-risk investment portfolio with your bank. You believe this new product could be a good fit for a portion of their portfolio, but you are unsure how to best present it without jeopardizing their trust or violating Alabama banking law. Which of the following approaches best balances regulatory compliance, ethical considerations, and client relationship management? Option A. Present the new product to the client, clearly explaining its features, potential benefits, and associated risks, and discuss how it might complement or differ from their current investment strategy, allowing them to make an informed decision. Option B. Recommend the new product as a superior alternative to their current holdings, focusing on the bank's expertise in managing such investments and encouraging a swift transition to maximize immediate gains. Option C. Introduce the new product as an option, but primarily focus on how its adoption would benefit the bank's profitability and market share, without delving deeply into the product specifics or its suitability for the client's individual circumstances. Option D. Emphasize the significantly higher potential returns of the new product, downplaying its increased volatility and suggesting it is a necessary upgrade to their current portfolio to keep pace with market trends. The correct answer is A. Present the new product to the client, clearly explaining its features, potential benefits, and associated risks, and discuss how it might complement or differ from their current investment strategy, allowing them to make an informed decision. Explanation. This scenario presents a professional challenge due to the inherent conflict between a bank's desire to secure new business and its fiduciary duty to act in the best interests of its existing clients. The bank officer must navigate the complexities of Alabama banking law, specifically regarding disclosure requirements and potential conflicts of interest when offering new products. Careful judgment is required to ensure compliance and maintain client trust. The best professional approach involves transparently disclosing the new product's features, benefits, and risks to the existing client, while also clearly explaining how it differs from their current investment and the potential impact on their overall financial strategy. This approach prioritizes the client's informed consent and aligns with the ethical obligation to avoid misrepresentation or undue influence. Alabama banking regulations emphasize fair dealing and full disclosure in customer relationships, particularly when introducing new financial instruments. This method ensures the client can make a decision based on complete information, respecting their autonomy and the bank's duty of care. An approach that focuses solely on highlighting the potential upside of the new product, without adequately detailing its risks or comparing it to the client's existing holdings, is professionally unacceptable. This constitutes a failure to provide full and fair disclosure, potentially misleading the client and violating Alabama banking laws that prohibit deceptive practices. Furthermore, failing to acknowledge the potential impact on the client's existing relationship with the bank, such as if the new product is less profitable for the client or creates a conflict of interest for the bank, is an ethical lapse. Another professionally unacceptable approach is to pressure the client into adopting the new product by implying it is a necessary upgrade or that their current investment is no longer optimal, without providing concrete evidence or a balanced comparison. This constitutes undue influence and a breach of the bank's duty to act in the client's best interest. Alabama law expects financial institutions to foster trust through honest and objective advice, not through coercive sales tactics. Finally, recommending the new product without understanding the client's current financial situation, risk tolerance, and long-term goals is also a significant failure. This demonstrates a lack of due diligence and a disregard for the client's individual needs, which is contrary to the principles of responsible banking and client-centric service mandated by Alabama regulations. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's existing relationship and financial objectives. This should be followed by a comprehensive assessment of any new product's suitability, including a clear articulation of its benefits, risks, and costs. Transparency and honesty in communication are paramount, ensuring the client is empowered to make informed decisions that align with their best interests. Question 14. The control framework reveals that Ms. Anya Sharma, a branch manager at a prominent Alabama bank, has a long-standing and valued client, Mr. Robert Henderson, who wishes to conduct a significant international wire transfer. Mr. Henderson is visibly impatient and requests that the transaction be processed quickly, implying that he would prefer to avoid providing extensive documentation about the source of funds, stating, "We've done business for years, Anya. You know I'm good for it. Let's just get this done." Ms. Sharma is aware that current Alabama banking law and federal regulations require enhanced due diligence for such transactions, including detailed documentation of the source of funds, which Mr. Henderson seems reluctant to provide. What is the most appropriate course of action for Ms. Sharma? Option A. Process the wire transfer as requested by Mr. Henderson to maintain the client relationship and avoid potential loss of business, assuming his long-standing relationship implies legitimacy. Option B. Politely explain to Mr. Henderson that while the bank values his business, the transaction cannot proceed without full compliance with the bank's Know Your Customer KIC and anti-money laundering AML policies, and offer to guide him through the required documentation process. Option C. Immediately refuse the transaction and inform Mr. Henderson that his reluctance to provide documentation is suspicious, without further explanation or attempt to assist. Option D. Proceed with the transaction but submit a suspicious activity report (SAR) to the authorities, citing Mr. Henderson's impatience as the primary reason for suspicion. The correct answer is B. Politely explain to Mr. Henderson that while the bank values his business, the transaction cannot proceed without full compliance with the bank's Know Your Customer KIC and anti-money laundering AML policies, and offer to guide him through the required documentation process. Explanation. The control framework reveals a situation where a bank officer, Ms. Anya Sharma, is presented with a conflict between a long-standing client's request and the bank's internal policies designed to prevent money laundering. This scenario is professionally challenging because it pits the obligation to maintain client relationships and provide excellent service against the critical duty to uphold regulatory compliance and protect the financial system from illicit activities. Ms. Sharma must exercise careful judgment to navigate these competing demands without compromising either her professional integrity or the bank's legal standing. The best professional approach involves Ms. Sharma adhering strictly to the bank's established Know Your Customer KIC and anti-money laundering AML policies. This means politely but firmly explaining to Mr. Henderson that the bank cannot proceed with the transaction as requested due to regulatory requirements. She must then offer to assist Mr. Henderson in complying with these requirements, such as by providing the necessary documentation or explaining the process for a legitimate transaction. This approach is correct because it directly aligns with the Alabama banking law and federal regulations concerning AML and suspicious activity reporting. The Bank Secrecy Act, BSA, and its implementing regulations, as enforced by the Alabama State Banking Department, mandate that financial institutions implement robust KYC/AML programs to detect and report suspicious transactions. Failing to do so can result in severe penalties for the bank and the individuals involved. By prioritizing compliance, Ms. Sharma upholds her fiduciary duty to the bank and the integrity of the financial system. An incorrect approach would be to bypass the standard KYC/AML procedures to accommodate Mr. Henderson's request, perhaps by making an exception or downplaying the significance of the required documentation. This would be a direct violation of the Alabama banking law and federal AML regulations. Such an action would expose the bank to significant legal and financial risks, including fines, sanctions, and reputational damage. It also undermines the effectiveness of the bank's internal control framework and the broader efforts to combat financial crime. Another incorrect approach would be to simply refuse the transaction without offering any explanation or assistance. While this avoids direct violation of AML policies, it demonstrates poor client service and could lead to client dissatisfaction and potential loss of business. More importantly, it misses an opportunity to educate the client and potentially identify a legitimate transaction that has been hindered by a misunderstanding of the requirements. A professional approach seeks to balance compliance with client relations. Finally, an incorrect approach would be to report the transaction as suspicious without first attempting to understand Mr. Henderson's intentions or offering him a chance to comply with the bank's policies. While reporting suspicious activity is a crucial obligation, a premature report without due diligence could be unwarranted and damage the client relationship unnecessarily. The professional reasoning process should involve a thorough understanding of the client's request, a clear articulation of the bank's regulatory obligations, and a proactive effort to find a compliant solution. This involves a risk-based approach, where the bank assesses the risk of the transaction and applies appropriate controls, while also maintaining open communication with the client. Question 15. The evaluation methodology shows that a loan officer at an Alabama chartered bank has been discussing a potential modification to a long-standing customer's commercial loan agreement. During these discussions, the loan officer, aiming to retain the customer's business, verbally indicated that a specific, non-standard modification requested by the customer would likely be approved, even though the loan officer had not yet confirmed if this modification was permissible under the existing loan covenants or bank policy. The customer, relying on this assurance, has begun making business decisions based on the expectation of this modification. The loan officer now realizes that the requested modification directly contradicts several key clauses within the original loan agreement and would require formal board approval, which is highly unlikely to be granted. What is the most appropriate course of action for the loan officer to take to mitigate potential legal and ethical repercussions for the bank under Alabama banking law? Option A. Immediately inform the customer that the previously discussed modification cannot be made due to specific contractual limitations, clearly explain which loan covenants prevent it, and proactively offer alternative, contractually compliant solutions or modifications. Option B. Avoid further discussion with the customer about the loan modification and hope that the customer eventually drops the request or forgets the previous assurances. Option C. Agree to the modification without seeking further internal or legal review, believing that the customer's loyalty and the loan officer's intent to help justify the deviation from standard procedure. Option D. Proceed with the modification as discussed, assuming the customer's reliance will create a de facto approval and that the bank's internal review will overlook the contractual discrepancies. The correct answer is A. Immediately inform the customer that the previously discussed modification cannot be made due to specific contractual limitations, clearly explain which loan covenants prevent it, and proactively offer alternative, contractually compliant solutions or modifications. Explanation. The evaluation methodology shows that this scenario presents a significant professional challenge for a loan officer at an Alabama chartered bank, due to the inherent conflict between fulfilling a customer's immediate request and adhering to the bank's contractual obligations and fiduciary duties. The loan officer must navigate the potential for a breach of contract claim against the bank, while also considering the ethical implications of misleading a long-standing client. Careful judgment is required to balance customer relations with legal and regulatory compliance. Correct approach involves promptly informing the customer about the bank's inability to fulfill the loan modification request as initially discussed, clearly explaining the specific contractual clauses that prevent such a modification, and offering alternative solutions that are within the bank's legal and contractual purview. This approach is correct because it prioritizes transparency and adherence to the existing loan agreement, thereby preventing a breach of contract. Alabama banking law, like general contract law, emphasizes the importance of upholding the terms of written agreements. By clearly communicating the limitations imposed by the contract and offering compliant alternatives, the loan officer acts ethically and legally, protecting the bank from potential litigation and maintaining a professional relationship based on honesty. This aligns with the ethical duty of a financial institution to act in good faith and to not misrepresent its capabilities or contractual obligations. An incorrect approach involves proceeding with the modification without proper authorization or adherence to the contractual terms, hoping that the issue will not be discovered or will be overlooked. This is professionally unacceptable because it directly leads to a breach of contract. The bank would be violating the terms of the original loan agreement, exposing itself to legal action by the borrower for damages resulting from the unauthorized modification. Furthermore, it violates the ethical duty of honesty and integrity expected of financial institutions and their employees. Another incorrect approach involves delaying communication with the customer and avoiding the topic, hoping the customer will forget or drop the request. This is professionally unacceptable as it constitutes a failure to act in good faith and can be interpreted as a deliberate attempt to mislead the borrower. Such inaction can still lead to a breach of contract if the customer relies on the implicit understanding that the modification would occur, and the bank later refuses or is unable to implement it. It also erodes trust and damages the bank's reputation. A further incorrect approach involves unilaterally agreeing to the modification without consulting legal counsel or obtaining the necessary internal approvals, even if the loan officer believes it is in the customer's best interest. This is professionally unacceptable because it bypasses established bank policies and legal review processes designed to ensure compliance with Alabama banking laws and contractual obligations. Such actions could result in the bank being bound by an agreement that is not legally sound or is detrimental to its financial health, potentially leading to regulatory scrutiny and financial penalties, in addition to a breach of contract claim. The professional decision-making process for similar situations should involve a thorough review of the existing contract, consultation with legal and compliance departments when any ambiguity or deviation from standard procedure is encountered, clear and honest communication with the customer, and the exploration of all legally permissible and contractually compliant alternatives. Question 16. The monitoring system demonstrates a significant increase in the bank's exposure to interest rate risk due to a growing imbalance between the maturity of its fixed-rate loans and its variable-rate deposits. Considering the regulatory expectations for asset liability management under Alabama banking law, which of the following actions best addresses this emerging risk? Option A. Increase the bank's reliance on short-term brokered deposits to meet potential liquidity needs, while deferring a formal review of the loan portfolio's interest rate sensitivity. Option B. Focus on acquiring more long-term fixed-rate investment securities to offset the yield on existing fixed-rate loans, thereby maximizing immediate net interest income. Option C. Implement a comprehensive strategy that includes regular stress testing, scenario analysis, and the establishment of clear policies and limits for interest rate and liquidity risk, ensuring alignment with the bank's capital adequacy. Option D. Delay any significant adjustments to the balance sheet until market interest rates stabilize or begin to decline, to avoid making costly decisions in a volatile environment. The correct answer is C. Implement a comprehensive strategy that includes regular stress testing, scenario analysis, and the establishment of clear policies and limits for interest rate and liquidity risk, ensuring alignment with the bank's capital adequacy. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a bank to balance its immediate liquidity needs with its long-term solvency and profitability, all while adhering to the specific regulatory requirements of Alabama banking law. The challenge lies in identifying and mitigating risks associated with mismatched asset and liability maturities, which can lead to significant financial distress if not managed proactively. Careful judgment is required to ensure that the bank's asset liability management strategy not only meets regulatory expectations, but also safeguards the institution's financial health and its ability to serve its customers. Correct approach analysis. The best professional practice involves a comprehensive program that integrates interest rate risk, liquidity risk, and capital adequacy. This approach necessitates the establishment of clear policies and procedures, regular stress testing, and the use of sophisticated modeling to forecast potential impacts of market changes on the bank's balance sheet. Specifically, under Alabama banking law, banks are expected to maintain sound practices to ensure their safety and soundness. This includes having a robust framework for identifying, measuring, monitoring, and controlling risks arising from mismatches between assets and liabilities. The proactive and integrated nature of this approach directly aligns with the supervisory expectations for prudent risk management, aiming to prevent adverse financial outcomes before they materialize. Incorrect approaches analysis. One incorrect approach focuses solely on maximizing short-term profits by investing in longer-term, higher-yielding assets without adequately considering the potential for rising interest rates to increase funding costs or reduce the market value of those assets. This strategy ignores the fundamental principle of which is to manage the overall risk profile of the bank, and can lead to significant interest rate risk and liquidity challenges, potentially violating the spirit and letter of Alabama's banking regulations concerning safe and sound operations. Another flawed approach involves a reactive stance, where adjustments are only made in response to immediate liquidity shortfalls or significant market movements. This reactive strategy fails to establish a forward-looking risk management framework. Alabama banking law emphasizes proactive risk management and the need for banks to anticipate and mitigate potential risks. A purely reactive approach leaves the bank vulnerable to sudden market shifts and can result in costly emergency measures, potentially indicating a lack of adequate internal controls and risk oversight. A third incorrect approach is to delegate responsibilities entirely to external consultants without establishing robust internal oversight and validation processes. While external expertise can be valuable, Alabama banking law expects the bank's board of directors and senior management to retain ultimate responsibility for the bank's strategy and risk management. Over-reliance on external parties without internal due diligence can lead to a disconnect between the bank's actual risk profile and the management of that risk, potentially resulting in non-compliance with regulatory expectations for internal governance and risk control. Professional reasoning. Professionals should adopt a proactive, integrated, and policy-driven approach to This involves establishing a clear committee with defined responsibilities, developing comprehensive policies that address interest rate risk, liquidity risk, and capital management, and regularly reviewing and updating these policies. The process should include scenario analysis and stress testing to understand potential impacts of various market conditions. Furthermore, professionals must ensure that strategies are aligned with the bank's overall business objectives and risk appetite, while strictly adhering to the regulatory framework set forth by Alabama banking law. Question 17. The monitoring system demonstrates that a long-standing customer of an Alabama-based bank has been making regular, substantial deposits into an account that was initially opened as a standard checking account. The customer recently inquired about the bank's responsibilities regarding the management and growth of these funds, referencing their understanding of a trust-like arrangement. Given the customer's inquiry and the account's history, what is the most appropriate initial step for the bank to take to accurately characterize the customer's banking relationship and its associated contractual obligations under Alabama banking law? Option A. Rely solely on the customer's verbal description of their understanding of a trust-like arrangement to guide the bank's response and internal classification. Option B. Advise the customer that standard checking accounts do not involve trust-like management and that their inquiry is outside the scope of typical deposit agreements. Option C. Assume the relationship is a standard deposit contract based on the account's initial designation and the customer's long-standing relationship with the bank. Option D. Conduct a comprehensive review of all account opening documentation, subsequent agreements, and any recorded communications to ascertain the precise terms and conditions governing the customer's account as established under Alabama law. The correct answer is D. Conduct a comprehensive review of all account opening documentation, subsequent agreements, and any recorded communications to ascertain the precise terms and conditions governing the customer's account as established under Alabama law. Explanation. This scenario presents a professional challenge because it requires a banker to interpret the nature of a customer's relationship with the bank and the associated contractual obligations under Alabama banking law, specifically concerning deposit contracts. Misclassifying the relationship could lead to significant legal and regulatory repercussions, including potential penalties for noncompliance with consumer protection laws and breach of contract. The core issue is distinguishing between a standard deposit account and a more complex arrangement that might involve fiduciary duties or specific service agreements. The best professional approach involves a thorough review of all documentation related to the customer's accounts and interactions. This includes examining the initial account opening forms, any subsequent agreements or addendums, and records of communication between the bank and the customer. Alabama law, like general banking principles, emphasizes the importance of clear contractual terms. A deposit contract is fundamentally an agreement where the bank accepts funds from a depositor, agreeing to repay them on demand or at a specified time, and to execute transactions as directed. This approach prioritizes adherence to the written terms of the agreement and Alabama's specific regulations governing deposit accounts, ensuring that the bank's obligations are clearly defined and met. An incorrect approach would be to assume the relationship is solely a standard deposit contract based on the customer's stated intent, without verifying the actual contractual terms. This overlooks the possibility that the customer may have entered into, or intended to enter into, a more specialized agreement that alters the bank's responsibilities beyond those of a typical deposit account. Alabama banking regulations require banks to act in accordance with the agreements they establish with their customers. Another incorrect approach is to rely solely on the customer's verbal assurances about their expectations without cross-referencing these with the bank's established account agreements. While customer service is important, the legal framework of banking contracts is built upon written agreements. Alabama law mandates that banks operate within the confines of their contractual agreements and applicable statutes. Finally, an incorrect approach is to dismiss the need for detailed documentation review because the account has been active for a long time. The duration of an account's existence does not negate the importance of the underlying contractual terms or absolve the bank from its obligations as defined by those terms in Alabama law. Each deposit contract, regardless of its age, is subject to the legal framework in place at the time of its formation and operation. Professionals should employ a decision-making framework that begins with identifying the governing legal framework, Alabama banking law. Next, they must meticulously review all relevant documentation to understand the precise nature of the contractual relationship. This involves comparing the customer's stated needs and expectations against the explicit terms and conditions of the agreements in place. If ambiguities exist, seeking clarification from legal counsel or compliance officers is paramount to ensure adherence to regulatory requirements and ethical obligations. Question 18. The monitoring system demonstrates a significant weakness in its ability to detect potential money laundering activities, a critical compliance area for financial institutions operating under Alabama banking law. Which regulatory agency should the bank prioritize informing about this deficiency? Option A, the Office of the Comptroller of the Currency, OCC. Option B, Internal Audit Department only. Option C, the Federal Deposit Insurance Corporation, FDIC. Option D, the Alabama State Banking Department. The correct answer is D, the Alabama State Banking Department. Explanation. This scenario presents a professional challenge because it requires a bank to navigate the complex oversight responsibilities of multiple federal and state banking regulatory agencies, specifically within the context of Alabama banking law. The bank must ensure its internal monitoring systems are not only effective in identifying potential issues, but also aligned with the reporting and compliance mandates of the relevant authorities. Misinterpreting or misapplying the roles of these agencies can lead to regulatory violations, penalties, and reputational damage. Careful judgment is required to determine which agency's purview is most directly implicated by the identified monitoring system deficiency. The best approach involves recognizing that the Alabama State Banking Department is the primary state-level regulator for state-chartered banks operating within Alabama. While federal agencies like the FDIC and OCC have significant roles, the state banking department has direct supervisory authority over the day-to-day operations and compliance of state-chartered institutions. Therefore, reporting a deficiency in the internal monitoring system, which directly impacts the bank's operational integrity and risk management, to the Alabama State Banking Department is the most appropriate first step. This aligns with the principle of maintaining open and direct communication with the bank's chartering authority regarding material operational weaknesses. The Alabama Banking Code vests the State Banking Department with the responsibility to examine and supervise state banks, ensuring they operate in a safe and sound manner. An incorrect approach would be to solely rely on the FDIC for reporting such a deficiency. While the FDIC is a federal insurer and has supervisory powers, especially for insured state non-member banks, the Alabama State Banking Department is the direct chartering and primary supervisory authority for state-chartered banks in Alabama. Failing to inform the state regulator first could be seen as circumventing the primary oversight body. Another incorrect approach would be to only report the issue to the Office of the Comptroller of the Currency, OCC. The OCC is the primary regulator for national banks and federal savings associations. Since the question implies a bank operating under Alabama law, it is likely state-chartered, making the OCC's direct supervisory role less relevant for this specific type of deficiency, unless the bank also holds a national charter or is a federal savings association, which is not indicated. Finally, an incorrect approach would be to assume the deficiency is solely an internal matter and not report it to any external regulatory agency. This would be a significant failure in risk management and regulatory compliance, as internal monitoring systems are critical for identifying and mitigating risks that could impact the safety and soundness of the institution, which is a core concern for all banking regulators. Professionals should employ a decision-making framework that prioritizes understanding the bank's chartering authority and the specific roles of each relevant regulatory agency. When a deficiency is identified, the initial step should be to determine which agency has primary supervisory responsibility for the bank's charter and operations. Open and transparent communication with that primary regulator is paramount. Question 19. The monitoring system demonstrates a series of large, sequential cash deposits into a business account in Alabama, which are slightly below the reporting threshold for currency transaction reports, CTR. The account holder, a small retail business, has provided a general explanation that these are seasonal sales receipts. What is the most appropriate course of action for the bank's compliance officer to take under Alabama's anti-money laundering (AML) regulations? Option A. Close the account immediately due to the potentially suspicious nature of the deposits, without further investigation or reporting. Option B. Contact the customer directly to ask for more specific details about the seasonal sales receipts before any internal investigation is completed. Option C. Conduct a thorough internal investigation, reviewing the customer's full transaction history, business profile, and any available contextual information to determine if the deposits are consistent with legitimate business operations, and if suspicion remains, file a suspicious activity report, SAR. Option D. Immediately file a suspicious activity report, SAR, with the appropriate authorities based on the pattern of deposits, even without further investigation. The correct answer is C. Conduct a thorough internal investigation, reviewing the customer's full transaction history, business profile, and any available contextual information to determine if the deposits are consistent with legitimate business operations, and if suspicion remains, file a suspicious activity report, SAR. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a banker to interpret complex transaction monitoring alerts within the context of Alabama's specific banking laws and anti-money laundering (AML) regulations. The difficulty lies in distinguishing between potentially suspicious activity and legitimate, albeit unusual, transactions, while also ensuring compliance with reporting obligations and maintaining customer relationships. A misjudgment can lead to significant regulatory penalties, reputational damage, and even criminal liability for the institution and individuals involved. Correct approach analysis. The best professional practice involves a thorough, documented investigation of the alert, gathering all relevant internal and external information, and applying a risk-based approach consistent with Alabama's AML framework. This includes reviewing customer due diligence, CDD, information, transaction history, and any available contextual data. If after this comprehensive review, the activity remains unexplained and potentially indicative of money laundering, the appropriate next step is to file a suspicious activity report, SAR, with the relevant authorities as mandated by Alabama banking regulations. This approach prioritizes regulatory compliance and risk mitigation through diligent investigation and timely reporting. Incorrect approaches analysis. One incorrect approach involves immediately escalating the alert for SAR filing without conducting a proper investigation. This bypasses the critical due diligence required by Alabama's AML regulations, which emphasize a risk-based assessment. Such a hasty action could lead to unnecessary SAR filings, burdening law enforcement and potentially damaging the reputation of innocent customers. Another incorrect approach is to dismiss the alert solely based on the customer's stated business purpose without independent verification or further inquiry. Alabama's AML laws require more than just accepting a customer's explanation. The bank must exercise reasonable diligence to ensure the explanation is credible and consistent with the observed transaction patterns. Failing to do so represents a significant compliance failure. A third incorrect approach is to contact the customer directly to inquire about the suspicious transaction before completing an internal investigation and determining if a SAR is warranted. This action, often referred to as tipping off, is a serious violation of AML regulations in Alabama and can alert the suspected money launderers, allowing them to evade detection and potentially destroy evidence. Professional reasoning. Professionals should adopt a systematic, risk-based approach to transaction monitoring alerts. This involves establishing clear internal procedures for alert investigation, ensuring adequate training for staff on AML regulations specific to Alabama, and maintaining robust documentation of all investigative steps and decisions. When faced with an alert, the decision-making process should prioritize understanding the nature and purpose of the transaction, assessing the associated risks, and then determining the appropriate regulatory response, which may include filing a SAR if suspicious activity cannot be reasonably explained. Question 20. The monitoring system demonstrates that a consumer loan originated by an Alabama-based financial institution had a disclosed annual percentage rate, APR of 7.25%. Upon review, it was determined that the actual finance charge, including all applicable fees and interest, resulted in an actual APR of 7.00%. Assuming this is a regular transaction, what is the lender's obligation under the Truth in Lending Act TILA as enforced in Alabama? Option A. The lender must investigate the software error, but is not required to take immediate corrective action until a pattern of such errors is identified. Option B. The lender is not obligated to take any action as the disclosed APRA is higher than the actual APRA. Option C. The lender must only refund the difference between the disclosed and actual interest rate, but no redisclosure is necessary. Option D. The lender must redisclose the corrected APRA of 7.00% to the consumer and refund any excess finance charges collected. The correct answer is D. The lender must redisclose the corrected APRA of 7.00% to the consumer and refund any excess finance charges collected. Explanation. The monitoring system demonstrates a potential violation of the Truth in Lending Act TILA as implemented in Alabama, specifically concerning the calculation and disclosure of the annual percentage rate, APRA, for a consumer loan. The scenario is professionally challenging because it requires precise mathematical calculation and a thorough understanding of TILA disclosure requirements to ensure consumer protection and regulatory compliance. Miscalculating or misrepresenting the APRA can lead to significant penalties, including rescission rates for the consumer and fines for the lender. The correct approach involves accurately recalculating the APRA based on the actual finance charge and the amount financed, then comparing it to the disclosed APRA. If the disclosed APRA is higher than the actual APRA by more than a de minimis amount, typically 1/8 of a percentage point for regular transactions, or 1/4 of a percentage point for irregular transactions, as per Regulation Z, which governs TILA, then a TILA violation has occurred. This approach is correct because TILA mandates that the disclosed APRA must be a close approximation of the actual cost of credit. Alabama law, by adopting and enforcing federal TILA provisions, requires lenders to provide accurate disclosures to consumers. The specific calculation involves determining the finance charge, all costs of credit, including interest, points, and certain fees, and the amount financed, then using an actuarial method or a standard formula to derive the APRA. If the disclosed APRA exceeds the actual APRA by more than the permissible tolerance, corrective action, such as redisclosure and potentially a refund of excess finance charges, is required. An incorrect approach would be to assume the disclosed APRA is correct simply because it was provided by the loan origination software, without independent verification. This fails to acknowledge the lender's ultimate responsibility for the accuracy of disclosures under TILA. Another incorrect approach is to only consider the stated interest rate and ignore other finance charges that must be included in the APRA calculation, such as origination fees or private mortgage insurance premiums, if applicable. This overlooks the comprehensive definition of finance charge under Regulation Z. A third incorrect approach is to dismiss the discrepancy as a minor clerical error without performing the necessary recalculation and assessing the tolerance thresholds. This demonstrates a lack of due diligence and a failure to adhere to the strict accuracy requirements of TILA. Professionals should adopt a systematic approach to APRA verification. This involves 1. Identifying all components of the finance charge as defined by Regulation Z. 2. Determining the exact amount financed. 3. Using an approved APRA calculation method to derive the actual APRA. 4. Comparing the actual APRA to the disclosed APRA, paying close attention to the permissible tolerance levels. And 5. Taking immediate corrective action if a violation is identified, including redisclosure and potential restitution to the consumer, in accordance with Alabama's adherence to federal TILA regulations.